Joining us is Marathon Asset Management CEO Bruce Richards. Welcome back. Great to have you on a Fed Day.
Great to be here.
So what do you think is going to happen today?
Well, after 15 months, 10 straight hikes, this is the day. It's the day where they move sideways and they no longer hike. And forget that 70 to 80% probability that a hike comes in July or September. I think they're on hold for an extended period of time.
You think this is it? We're done.
And so I think they're done after today. You know, what the economists that work at the Fed, these PhDs and the economists that work there, that work on these models, they have a variable in the equation called R, and R is interest rates. And that's the one thing they can control more than anything is R, interest rates. And in that variable, they try to equate where demand is equal to supply, because when demand's too much greater than supply, it creates a lot of inflation, right? So they try to create a dynamic where demand is equal to supply or just marginally higher than supply, creating a 2% inflation rate. And so they don't want to tinker with that once they've settled on the rate. So once they stop here at 5, I believe they're done for an extended period of time. Extended period is the rest of this year into next year. And so I don't expect any Fed lowering of rates for some extended period of time because they put a lot of money in the money supply. They cut rates at zero for too long. They created too much inflation. A lot of that is on the Fed. And what they want to do, really, is exit left. Let the markets do its work. Let their work that they've done at 5% Fed funds rate do its work to slow things down, slow the demand side of the equation down. And I think they don't want to tinker with it. So my best advice for Chairman Powell is be Ferris Bueller. Like, take some time off after today.
So, I mean, this is where Fed policy gets more into art than science, though, because you could make the case that demand has not fallen off enough to prevent inflation from remaining sticky, especially in core services parts of the economy, and unemployment has not cracked, and therefore wages will continue to put pressure on prices.
So make that case. So now let's...
I just did.
You did? And that's a very eloquent case. And Sarah, you make a strong argument there. So let's talk about the reality on the ground from the vantage point that I see. And let's go back to June 8th, where the debt ceiling was fixed and it was codified by Congress, signed into law by President Biden. And now there's two major impacts that come from out of that. So let's talk about one, and we'll talk about the second in just a second. The one very important thing is beginning September 1st, about 30 million Americans, remember there's about 150 million Americans that work. So 30 million Americans, about 1/5 the working force, have to start paying their student loans.
Yeah.
30 million have to pay between $300 and $400 on average monthly, which is about 100 billion plus of consumption on an annual basis that starts at September 1 after never having paid a student loan since March of 2020. So 3 years and 6 months will be September. They have not made a mortgage not made a student loan payment, and all of a sudden they start to have to pay. And so what does that do to the demand side of the equation? Because it's 1/5 of all consumption here in this country in terms of, the consumer population. So what does that mean to Macy's? What does that mean to Lululemon? What does that mean to companies that have discretionary spending?
Key demographic,
and as the summer comes to an end, and these are a big cohort of our travelers, they'll stop traveling less. So the second thing that came out of the big debt ceiling arrangement is that Janet Yellen can now start to spend again, i.e. start to issue treasuries. And our fiscal year end is September 30th, right? And so think about like the nearly $1 trillion of treasuries that are going to be issued. So inflation's coming down, got that, coming down from 8 to 10% to around 4% where it is now. I think demand does soften further because I think we are moving to that recession. The train's left the station. I think it's inevitable that will happen. But you won't know it until the second quarter of next year when you see that Q4 of this year and Q1 of this year was a recession, and they report that in April of next year. So with $1 trillion of treasuries, rates are now moving a little higher, and they have. And with that, there's going to be a big crowding out, and we're seeing that already. So there's the crowding out, it's the tighter fiscal conditions and monetary policy conditions that will inevitably lead to it, I believe.